Welcome to this Killick Explains video, unsurprisingly on 4 tax resolutions for 2023. Now, you might be thinking, hasn't he gone out of the gates a bit early here? But the end of tax year, the 5th of April, comes up pretty fast. It is the 5th of April, as a reminder, so 5th of April 2023. You don't want to leave everything until then. Quite a bit of what I'm about to say is use it or lose it. So if you forget, then you don't get the opportunity in the next tax year to catch up, if you like. And worth flagging the fact that once we get to the 6th of April, quite a bit of the autumn statement kicks in, and that will change one or two of the areas I'm going to be talking about. So, what are my 4 top tips, if you like, between now and the 5th of April 2023? Number 1, use individual savings accounts, ISAs. Arguably, this is more important than ever and is going to become a lot more important once some of the stealth taxes, as they're known, kick in on the 6th of April. All right, but basically, things that are coming in the pipeline, the annual dividend and capital gains tax allowances are going to drop away. All right, and that will have quite a big impact on people's ability to save tax outside of a tax shelter like this. So what do we got? You've still got, thank goodness, although it hasn't increased with inflation, one might say, an annual allowance of £20,000 per year per adult. On top of that, you've got junior ISAs, and that is now up to £9,000 per child, with contributions able to come channeled through parents from almost anywhere, in fact. And I think, given that stealth taxes are a big part of the autumn statement, given that we're going to see the generosity, if you like, of certain non-tax shelter allowances fade away, and that's not apparent yet, because this hasn't kicked in yet, using ISAs and junior ISAs is going to become more important than ever. Number 2, pensions. Now, the great thing about pensions is you get tax relief on the way in. They are outside of a death estate for inheritance tax purposes. You can carry forward unused allowances for 3 years. That's still true. That hasn't been altered. All right. But what people are going to have to think about in terms of where they prioritise pension contributions once we get beyond the 5th of April, let alone up to the 5th of April, is one of the autumn statement changes for 2023-24 is a reduction in the additional rate tax threshold. And that's going to mean for people in particular who earn a certain amount of money, somewhere between about 100,000 and 150,000, for example, paying into a pension, if you can afford to do so with inflation, cost of living rising, becomes incredibly tax effective. It's tax effective now, it's going to get even more tax effective from the 6th of April. And I'll leave it there. But at the end, give you a reference source if you want to find out more about what I just said. But, you know, tax effective investing and saving through pensions, never been more important, arguably, than it is today. Then consider inheritance tax planning. Now, I've just mentioned one way of doing it. You know, a private pension is normally outside of a death estate, as they call it, when it comes to IHT. And remember, inheritance tax hits a death estate at 40% flat rate, with very few exceptions. So IHT planning, all right, bear in mind that the autumn statement has continued to freeze the basic inheritance tax allowances. So that's a maximum of 500,000 per person, basically comprising the 325,000 basic allowance and the residence nil rate band on top, subject to certain conditions, of another 175,000. So for a couple, there is £1 million worth of death estate potentially outside the clutches of HMRC. But that means for quite a few families, the name of the game is still reducing a death estate to make sure that they don't suffer what is quite a penal tax unless they deliberately want to do so. So how to do it? Well, potentially exempt transfers. Fortunately, those are still available. The problem with them is, in order to get a gift outside of a death estate, the gift needs to be made at least 7 years prior to death. Okay, there are qualifying gifts. All right, so it is possible to give away amounts to charities, political parties, in respect of weddings. There's an annual single gift allowance, £3,000. Then additional ones to any number of other people of £250. There are ways in less than 7 years, if you like, in a shorter time frame, to get rid of assets, but you have to meet the criteria. And then there's business relief. So again, that 7-year rule can catch people out. Business relief kicks in after just 2 years on so-called qualifying assets. So for those people who might be prepared to take a long-term view on investing in smaller companies, for example, AIM stocks, there is a way to reduce what's effectively a 7-year rule down to sort of 2 to get 100% relief. So worth thinking about where you are in the inheritance tax planning sphere. And then finally, a general one, which is check your records. All right, make sure that every year, for example, an awful lot of people need to do tax returns or get someone to do tax returns for them. So make sure, as we head into the new year, you've got a record of income and outgoings, disposals, gifts, and so on. People often think, well, if I give an asset away, surely I don't need to worry about it for tax purposes. Well, you do, because HMRC want to know about gifts just to make sure there isn't any sort of tax evasion going on in terms of the way gifts are structured. And one to keep an eye on, if you think, well, I don't have any outgoings, I don't run a business, Tim, I can't write off a lot of stuff against tax. What about charitable donations? If you've been generous enough to make charitable donations during this tax year, and goodness knows it was a tax year where a lot of people probably felt that they should with everything that's going on in the world, those potentially can attract tax relief in a tax return. So the record keeping can apply just at that level as well as the bigger picture. Now, I've covered a lot of ground there, and I've left out a lot as well as including a lot. So if you're thinking, oh, I'm a bit rusty on tax, I'm still recovering from the Christmas festivities, if you like, then do ping an email in, editor@killick.com, to get a copy of my tax effective saving guide. That's got a sort of light blue cover. It's not one of the ones sitting next to me. There are also usually regular articles on tax efficiency and effectiveness in Confidant. Again, that's editor@killick.com. And if you'd like to just watch some more videos on inheritance tax, CGT, income tax, death estates, all this jargon I've been throwing in, do go to our extensive library, and that's killick.com/learn.